Mastercard is one stock super investors agree on. Is it a potential opportunity? Warren Buffett called not investing in this business and its main competitor one of his biggest mistakes. Thankfully for Warren Buffett, one of his investment managers at Berkshire Hathaway, Todd Combs, did. We'll reverse engineer his decision-making process to look at the most telling business numbers before we estimate not one but two fair intrinsic values for Mastercard. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing Mastercard stock for your portfolio. Then you're going to want to watch till the end when we give our rating. So, is Mastercard a potential opportunity? Right now, Mastercard trades for $386.31 per share. Year to date, Mastercard performs in line with the market. They're up about 11.5%, which is about where the S&P 500 is at. In the last 5 years, Mastercard beats the market. They compound at 15% annually. In the last decade, Mastercard beats the market by even more. They compound at 18% annually over this time. Since being listed just before the global financial crisis, Mastercard has beat the market by a ton. They're crushing it, compounding at 28% annually. That's not all for shareholders. Right now, Mastercard pays a 0.57% dividend yield. This small dividend yield is added to the gains in their stock. But the burning question is, why should we be paying close attention to Mastercard? 18 different super investors own Mastercard. These include Valley Forge, Chuck Akre, Guy Spear, Thomas Russo, and importantly, Todd Combs at Berkshire Hathaway. Mastercard is the 8th most owned stock by super investors. It makes up 1.1% of super investors' portfolios when they're combined together, with a hold price of $393.82 per share. Right now, Mastercard trades $80 above its 52-week low. They trade just $40 below their 52-week high. There's not a lot of short interest, with just 0.5% of their shares sold short. How big is Mastercard? They're one of the biggest companies in the world, with a $364.5 billion market cap. That's huge. Mastercard is the second largest payment processor in the world, having processed close to over $8 trillion in transactions during 2022. Mastercard operates in over 200 countries and processes transactions in over 150 currencies. It was founded in 1966 and is headquartered in Purchase, New York. Now with that understanding, let's dive deep into their numbers. Metric number 1, we want their average return on capital in the last 5 years to be above 14%. A normal business earns 7% returns on capital. When we look for a benchmark that's double this, we can build in margin of safety based on the quality of the business. Mastercard earns huge returns, but they have swung throughout this time. They were at 71% in 2018. These dropped to as low as 40.5% in 2020, and in 2022, they were at 58.5%. When these are averaged out, Mastercard earns 55.7% returns on capital in a given year. That's insane compared to a normal business. It's up more than 8 times. This is a huge check on metric number 1 for Mastercard. Metric number 2, we want growth to support their high returns. We're looking for sales, earnings, and free cash flow growth. This metric's all or nothing. These all need to be up. In this time, Mastercard's revenues are up by 58%, their earnings have grown by 75%, and their free cash flows have led the growth charge. They're up by 89%. Great to see this as Mastercard's margins are improving over this time. It's growth across the board. It's another check on metric number 3. Ultimately, a company is worth the value of its free cash flow now and until Judgment Day, discounted back by some reasonable interest rate. We'll look at Mastercard's free cash flows in 2 different ways, doing just that later in our video, so you won't want to miss it. Metric number 3, let's look at Mastercard from the view of an individual shareholder. We want earnings per share growth. Their earnings have grown by 75% over this time, and Mastercard has bought back 8.5% of their shares. With fewer shares outstanding and more earnings, Mastercard has grown their earnings per share. It's another check on metric number 3. Metric number 4, we want free cash flow per share growth. This is almost the same story. The only thing different is that Mastercard has grown their free cash flows even faster than they grew their earnings. Their free cash flows have almost doubled up until today. It's another check on metric number 4. So far, so good. Mastercard is perfect through 4 metrics. Can they keep this up? We'll find out soon, but first, let's check in on our bonus. Right now, Mastercard pays a 0.57% dividend yield, but is it safe and does it have room to grow? That's what we're trying to figure out through our bonus. We want their dividends to be supported by their free cash flows. This has been the case in all 5 of the last years. Mastercard has grown their dividends in all 5 years. They easily support these with their free cash flows as they maintain a small dividend payout ratio. Their dividends are supported today. It's exactly what we want to see. This is another check on our bonus. It's businesses with too much debt that can have the biggest losses, fail, and go broke. Metric number 5, we want their net debt to be below the sum of their free cash flows in their last 5 years. Mastercard has added on to their debt over this time. They actually had $2 billion in cash in 2018 after paying off their debts. Last year, they had around $7 billion in net debt. Today, they have around $8.6 billion in net debt. They've added on to this. At the same time, Mastercard has grown their free cash flows. In the last 5 years, they generated $40.4 billion of free cash flow. That's massively above their net debt position. They easily support this. It's another check on metric number 5. In their last 12 months, Mastercard produced $11.1 billion of free cash flow. They'd be able to pay off all their net debt in just under a year. Flawless through our first 5 metrics, does Mastercard have what it takes to go 6 for 6 on our analysis and be a perfect select 6 stock? Let's find out. The big metric of them all, metric number 6, we want Mastercard's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a small risk premium to the yield of the 10-year treasury. It's the first of 2 ways we'll use Mastercard's free cash flows to estimate their fair value. Right now, Mastercard has a $373 billion enterprise value. This adds up their net debt and their market cap to look at Mastercard like a private business. In the last 5 years, we learned they produced $40.4 billion of free cash flow. This means in an average year, they earn $8.1 billion of free cash flow. When we divide that by their enterprise value, we get a 2.2% average free cash flow to enterprise value yield. Currently, Mastercard produced $11.1 billion of free cash flow in their last 12 months. When we divide that by their enterprise value, we get a 3% current free cash flow to enterprise value yield. These both come in below the yield of the 10-year treasury. They're down from the risk premium we wanted as well. This means all the way on metric number 6, this is our first and only X for Mastercard. Don't just throw the business out. You're going to want to see what their fair value per share is before you watch for our rating. Everything we've covered so far is important, but there's something missing that, in my opinion, is the main reason to analyze Mastercard. This brings us to using a discounted cash flow model to estimate their fair value. A DCF model is based on the predictability of a company's free cash flows. Like any model in any field, its outputs are sensitive to its inputs. Mastercard has been super predictable in their past. That's not a guarantee though for their future. We'll take their free cash flows and use historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for Mastercard. Assuming they grow their free cash flows at 16% in each of the next 10 years, then in the following decade, let's assume this growth rate is cut in half and these grow at 8%. We won't add in their tangible book value as that may be reduced because of their share buybacks. Still, if we want a market-beating 15% rate of return like Warren Buffett, at today's valuation multiples, an estimate of Mastercard's fair value is around $198 per share. Please keep some key points in mind. As a company gets bigger, it's likely that its growth rate declines. Mastercard has also traded for a pretty penny over the last decade. Right now, they trade at a price to owner earnings of 42 times. This is around their median, although they did trade for a minimum of about 22 times, just about half of this. This doubling of their multiples added as much as 7% to their returns over this time. It's something you want to be mindful of as a shareholder. It's more likely that in the future, Mastercard's multiples may decline rather than keep increasing. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before you make any investment decision. Warren Buffett and Todd Combs care about the numbers, but the qualities of a business are even more important to them. Let's learn what these business qualities are for Mastercard. Let's start with a long thesis. Number 1, Mastercard historically has outperformed Visa in terms of growth. Its smaller size and some leveling in market share between the two could maintain this trend. Number 2, there's still plenty of runway for growth in electronic payments. Electronic payments only surpassed cash payments on a global basis a couple of years ago. Number 3, management is appropriately focused on long-term growth opportunities and not near-term margins. But it's not all sunshine and roses. Let's cover the negatives for Mastercard too. Number 1, Mastercard is a distant number 2 player in a scalable industry, which could hamper long-term margins. Number 2, the oligopolistic nature of the industry makes Visa and Mastercard a target for regulators, and the company have historically paid some large fines. Number 3, UnionPay provides an example of how governments could favor local networks, and this could shut Mastercard out of some emerging market opportunities. This is a problem for Visa too. The companies have had to deal with something similar in both India and Brazil, two high-growth payment markets. Now let's combine Mastercard's qualities with their numbers as we give a rating. This far in our Mastercard stock analysis, ticker symbol MA, we have learned it's no surprise why so many super investors love the business. Mastercard has the signs of being a wonderful company. They earn huge returns on capital at about 55%. They've grown a lot in the last 5 years. They also bought back some shares. While they did add on some debt, they easily cover this using their cash flows. Mastercard has also supported a growing dividend. They could be a good dividend growth stock and maybe even future dividend royalty. The big knock against the business came when we looked at their free cash flow yields. These don't look attractive compared to the 10-year treasury. When we performed our discounted cash flow analysis, from today's valuations, if you believe those assumptions and you want a market-beating rate of return of 15% like Warren Buffett, an estimate for Mastercard's fair value is only around $198. That's down a good amount from their current stock price. They last traded there in January of 2019. This amount matches their performance since then. When we look at their qualities and their numbers and we put those together, Mastercard looks like a great candidate for more research. If you enjoyed today's MA stock analysis, like it, subscribe to the channel for more, and be sure to watch this next video.